welcome to another episode of the Cross Country Super Podcast. And as always, I'm joined by Jemma Sanderson over in the West in lovely Perth. How are you, Jemma?
I'm good, Darin. How are you?
I'm very well, as usual. It's fantastic to see you.
You too?
And of course, this episode is brought to you by SMSF Property Valuations. Need a current or retrospective SMSF property valuation? Whether it's for annual financial statements, pension commencement, or related party transactions, SMSF property valuations offer fast, reliable, and audit-ready reports across Australia. And it kind of segues very nicely into the topic that we're talking about today, or we plan to talk about today.
Sure does.
That is it's a bit of a hodgepodge today, wouldn't you say, Gemma? We've kind of come to the decision that we're going to talk about year-end issues. I
Yep.
know that's a very, very broad topic, and there are a
Very
lot
broad.
of things under this umbrella that we will be going into. So please forgive us because there's even more opportunity today to go completely off-piste,
Beast.
which I
Yep.
like doing. So we do start to ramble in a slightly different direction. That's the excuse for it, but we will try to bring it back on topic as much as we can, even though I know that we're not sometimes very good at doing that.
Sometimes we're not that reliable at doing that, but we can always be relied upon to go off piste.
Correct, correct. So if we're talking about year-end issues, and obviously this is in the lead up to the 30th of June, which will be upon us before we can even blink.
Exactly.
Where do you want to start?
Let's start with the main, the big ticket items, your contributions, your pensions, those sorts of things. And I think the contributions element is really important. In a previous episode, we spoke about the indexation, and so that's important in terms of looking at, okay, contributions are being indexed next year. What's the cap this year? What's the cap next year? Are we looking at carry forwards? Do we consider not making contributions this year because next year we want to put in more for our non-concessionals? All those sorts of fun things. With the year-end issues that can arise with contributions, the biggest consideration in SMSF land is that the money is received by the fund by the 30th of June, and that's physically in the fund's bank account. And so that's where some people can come a cropper. And so the consideration with that is if you're going to make a contribution, make sure it's done a week earlier, just to avoid any issues with the banks. And I mean, they're usually pretty quick with instantaneous payments and things like that, but you just never know. There could be an issue there. So it's worthwhile double, triple checking. And I think the consideration with that is especially if you've got someone looking to do the carry forward catch up and it's a substantial amount that they're looking to claim as a tax deduction. And so if you miss that, I'm sure you might be blacklisted then from that perspective.
Yeah, it's another one of these things where technology is supposed to help us, but I think it's made it slightly more complicated in terms of this timing issue. Because I think, in the Stone Age method of writing out
Of a
checks,
check, of a
yeah,
check.
the
What's a
good
check,
old
Darin?
check,
What's a check?
the contribution was considered okay once you'd given the check
You'd
over.
handed the check
Yeah,
over.
that's
Yeah.
right. Once the physical handing over, that was it. Responsibility absolved. I'm
Mm.
okay. But now with the electronic stuff, as you said, it's actually got to physically hit the bank account before it's actually acknowledged, and that creates a whole myriad of different things. I mean, I haven't actually specifically looked at the calendar as to where the year-end days
I think it's a
fall,
Wednesday. Pretty
but
sure it's a Wednesday.
weekends and that sort of thing can really catch you out. And
Mm.
depending on whichever bank you're using, whatever their policy is, can be completely different. I mean, I can tell you that I struggle with salary payments over like Easter weekend and that sort of stuff because the bank I use, they don't take that into account. And my pay cycle goes through on a Friday, so Good Friday.
Right. Yeah, Good Friday. Yeah.
Actually, they don't. I mean, I'm not 100% sure why an electronic banking system has not
Can't make a
take
payment on a
into account
Friday.
this because
Yeah.
it's not like you've got to wait for somebody to go into the office to do it. But the bank I use don't take that into account. So if you don't get your request in or your process in before, it will actually be not processed normally. It will be delayed as if you did it on the Monday and Tuesday, which is completely unhelpful. And in this case, it's even worse because, as you said, Gemma, if you are actually relying on certain aspects to execute a particular strategy, you could miss out, and
Yeah.
and that's that's going to create another world of hurt, isn't it?
The other thing with it as well is we've a lot of people have really pulled back on their daily transfer amounts. So if you wanted to put in, it's 160 odd thousand you could put in this financial year and claim a tax deduction for if you've got that full suite of unused concessionals and this year, great. But if you can only transfer 20 grand per day from your personal bank account, then that, you've got to factor that into the situation. Now, some people I know will go into the bank and do it sort of manually with the people there and do the transfer across the counter effectively. So that might be what needs to happen. But especially if someone is really looking to use that larger amount, if they're making those concessional contributions that they want to claim a tax deduction for, or even this is the last opportunity they might have to trigger a bring forward because at 30 June 2025, their total super balance was under the 1.76, but it's now nudging north of 2 million because of the nature of their investments. So if they don't put in their 360 this year, then they're going to miss out. They can't do it next year. So it's really important to not just be thinking, it's a 29th, it's on immediate clear through the bank account or whatever. But then if your daily transfer limits mean it can't happen, and I think 30 June is a Wednesday, I think. So, God, I can't believe I don't know that off the top of my head. But yeah, so that's helpful if you make that on the Monday, but I wouldn't want to be missing out if you're talking a substantial tax deduction for getting money into
No,
super and all those sorts of things.
no, I certainly wouldn't be leaving it to the last minute. I
No.
mean, again, this isn't supposed to be a bank bashing exercise,
No.
and I'm deliberately not naming the bank that I use for my business. But there are all sorts of variables that they can throw up. You're right about the EFT limit. My daily EFT limit on my business account, no less, isn't personal account. This is a business account. Is $20,000. So
Right.
if you've got larger amounts to process, you have to split that into several
Lots.
payments.
Yep.
So you have to be conscious of that.
And
Also,
$20,000 is about the norm. Like I feel like that's pretty normal. Now I've just looked that up, and the 20th of June, 30th of June is actually a Tuesday. So that's really, really even more important to get it
yeah.
done the week before.
Yeah, 100%. You don't want that weekend before to interfere with what you want to do. And I've even got another cautionary tale as far as I said, I'm not trying to bash banks, but I had to process a transaction, a fairly large amount. I went into the bank. I was doing all the right things. I
All the
did
right
know I
things. Yeah.
had to process the transaction across the counter, and I got into the bank. I was well within the closing period of the bank, but there was a large queue there. And so I thought to myself, well, I'm okay. As long as I'm in the bank, no matter how big the customer queue is, you're already in the bank. Surely they've got to process your transaction and do it. But by the time the queue dissipated and I got to the front, it was it was
After
past
business
four,
hours.
it was past 4 o'clock, I think, or past 3:30, I think it was. So they didn't kick me out. So I said, "Oh, look, I've got to transfer this amount of money, blah, 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 for this transaction." And I was promptly told, "I'm sorry, sir. The cutoff for that
Yes.
amount of money in a transaction was 3:30 and it's gone past." And I said to them, "But I've been standing in a queue. I got in here like at 3 o'clock. I've been standing in a queue for half an hour. How can you not possibly, like, that's not my fault.
But
That's
surely they could just process it for the next day. But then, it's the next
No,
day.
I had to go back.
Oh,
I had to go back. You can imagine
yeah.
how I felt about
But I think the thing with
that.
that, like what you've highlighted, is the importance of getting it right and giving yourself ample time to do it. And so that's yeah, that's a substantial. Well, the other thing I see as an issue there is if someone's looking at like fully using their bring forward period because they've triggered in a previous year,
Yeah,
and then they might be eligible to put in 390 next year. So
yeah,
they're like, right, I'll take up this amount and then do the next one. And like any of those bits and pieces where we need to see the transaction in the fund's bank account by 30 June. And the other one is out of the bank account. So that would be your pension payments, making sure that those minimums are paid, because that can be a diabolical situation, obviously, when those aren't paid. And especially if I'd say a lot of the people listening in would have clients where they only make one payment a year.
yeah,
So
yeah,
or they might receive regular amounts, but they're small, or they just need them for their living expenses, and they make their top up at the end of the year. So really, really important to make sure that those amounts are taken from the fund's bank account and not just moved within bank accounts, because what we can also encounter is where the client says, yep, I made that payment, paid that 100 grand, but instead of paying it out of the fund to their personal account, they've paid it to the fund's other bank account. Um, so, just it's just ticking the boxes on all of those sorts of things.
yeah, 100%. And you make a good point. If you're actually talking about, or maximizing your contribution strategies, you're talking about potentially pulling all the levers. So if you've got all
Yeah.
the levers pulled, being carry forward unused, concessional contributions cap, as well as maybe triggering the 3 year
Yeah.
bring forward for non-concessional, that's going to be a substantial amount of money. And again, don't make the mistake that I did and not be able to process that transaction because you're in there too late or there's some sort of obscure rule. Now, I had to learn the hard way, unfortunately,
And
but
which we can all learn from that now. So
yeah.
that's
So
someone's done the hard yards
I
there,
had to
Darin.
do it. I had to do it. So learn from my lesson. Don't get caught out like that because this is one of those situations, always, Gemma, that we face in a myriad of walks of life where you don't know until it's actually affected you. Like I wouldn't have
That's
even
right. You
known
don't
about that
appreciate the impact.
until I
Yep.
stood in that queue and stood at the counter, dumbfounded when I was told that, oh, sorry, sir, you're gonna have to come back tomorrow because you missed the cutoff.
Yeah.
It's like, huh? You're kidding me, aren't you?
And I think that like again, it highlights a good point, because a lot of the banks, and this is not a bank bashing situation, it's just the nature of how the banks work these days, is most people execute transactions online. So they haven't had to have many people at bank branches. There aren't the tellers there. So if you do go to the bank, I've been there at opening, and there's already a queue of a dozen people waiting to get in to deposit money or pull out cash, and sometimes you're still waiting 30 minutes even though you got there when the bank opened. So I think it really, really highlights the importance of, if it is a large transaction like that, you've really got to give yourself a lot of leeway and a lot of time up front. For like, the last thing you want to do is be missing out on either an exemption from tax on the pension assets because you haven't paid your minimum, or that tax deduction if you're looking to claim, or topping up your contributions where you might otherwise then be over the limits, over the total super balance limits in a subsequent year. So, just unbelievably important to give yourself lots of time in order to make sure that all those boxes are ticked.
Yeah, because the transactions that we're talking about are not spur of the moment
No,
sort of
they're not.
things, right? So a lot of planning would have been put into this to say that, oh, Gemma, you can take advantage of, oh, you've got unused concession
Concessionals.
cap
Yeah.
room that you can actually use this year. And then, of course, if you want the bring forward thing, you've got that possibility. So a lot of thinking and planning goes into this. And of course, human beings are such that once the plan's in place, you're feeling pretty good about it. You've
Yeah.
committed to it and you're thinking, oh, yeah, Good. I'm actually doing something positive here with my superannuation. I'm going to be, in better shape as we move into the next financial year, only to find out, sorry, all the things that we talked about missed out because the
Missed
timing
out.
was bad on
Yeah.
on the execution. Don't want to
And
be.
we encounter that a bit is, a plan's as useless as a chocolate teapot if you haven't executed it or implemented it properly. And so the other, that sort of also brings up things like if you are looking to claim a tax deduction, there are requirements around that. So, big fund land and little fund and small fund land is you've got to do the notice of intent to claim the deduction, and that has to be lodged with the or given to the fund and acknowledged prior to the person's lodgement of their personal tax return. So in SMSF land, that tends to be a little bit easier because often the personal tax agent and the SMSF tax agent are the same, but there'd be many, many circumstances out there where they would not be the same because there's some substantial SMSF administration businesses out there. So that whole implementation of that strategy, once that contribution is made, look, complete the form because you can always amend it down if that's what you need to do.
Mm,
But if you don't have
mm.
it there at all, then you've got that issue sitting there. So again, there was a case, I can't remember the name of it off the top of my head, where someone had made all the contributions, submitted the form to the fund, but the fund hadn't acknowledged it and sent it back because the timing of when the form was lodged and when the contributions were made didn't match. So they could only acknowledge with respect to a certain amount of a contribution. This was for a large fund, and so yeah, they ended up not being eligible for the deduction, and because they lodged their personal return in the first week of July. Anyway, la da 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 da. We weren't talking big numbers here, but it just again highlighted the importance of the procedures and making sure that those are all followed.
It's just an unwanted consequence that is so easily avoided.
Yeah,
You just don't want to be kicking yourself to say, "Oh, if only
yeah,
I don't like this. If only I'd got it in on time." Blah blah. It's a little bit
yep.
like the sage words of Yoda, Gemma. It's do or do not.
Do
There
not.
is
There
no
is no
try.
try. Oh, couldn't be a more appropriate analogy there, Darin, than in this particular circumstance. 100%. Yeah, yeah, yeah. Oh, love Yoda.
All right. Where do you want to go next?
Well, I just want to further emphasize that minimum pension payment, like
Yeah.
how important it is. So, when you've got a fund with both, a lot of funds have two members, a couple that are in there and they're both in pension phase and you're paying out the minimums for them. So they're well, hopefully engaged and aware of that. Where that can also be an issue in terms of minimums not being paid is when someone dies and it's a reversionary pension. So where that's the case, that pension just automatically continues to the survivor, and so that means that the minimum pension payments still need to be made with respect to that account over the course of that year. So if the minimums have been able to be made before the person died, great, no further payments are required. But if they haven't, then those minimum payments still need to be made. And the challenge with that is so what we don't where we don't want people to not meet their minimum repayments for a couple of reasons. One is the exempt current pension income. Um, the exemption goes for that whole account for the whole year. There's then transfer balance cap implications and re-reporting, and you could end up with the situation that someone is not exempt from tax, not just for that year, but for the bulk of a subsequent year until it's detected. And that's when a new pension actually commences. It's not sort of an automatic start again from 1 July. And that came out in that amendment to the pension ruling TR 2013-5. So
Yes.
we've got to watch out for that. So then we've got our reversionary pensions, is that other consideration, is again, they're missing out on the exemption. But the other thing with that, and this is untested, but you don't want to be the test case, right? Is that if you don't meet the minimum on a reversionary pension or a death benefit pension, then is it really met the requirements under the SIS and tax provisions on it being a death benefit pension? And so, is there then the requirement for the survivor or the recipient to commute that pension and pay it out of superannuation into their own name entirely. So it's an area that hasn't been tested, but again, you don't want to be that test case where a massive chunk of money has to come out of super from that perspective. So again, minimum payments really, really important. If we're at this time of the year, we're getting to the pointy end of lodgements for SMSFs, and this the lodgement due date for many SMSFs is the 15th of May. Some of them it's the 5th or 6th of June, depending on what day that falls. So you could have until that time you might not know the balance of the fund. And then you've got those naughty funds that are overdue. So you might have the situation where you don't actually know what the minimum payment needs to be for the relevant year. So that's where you would certainly overshoot the landing there and take out more than you might have estimated, just to make sure that you're meeting that minimum payment. So it's just it's awareness and just making sure all of those bits and pieces are ticked off on.
Yeah, and I know that we've discussed this in a previous episode of this podcast series, but the emphasis has to be put on the fact that the pension rules have changed because of that tax ruling that
Mm.
you referred to. And if you miss your minimum pension payment obligation, that puts you in a world of hurt
Yeah,
as far as what happens to that income stream from that point onwards. And we're not going to go into the detail now,
no,
but it's tricky. It's convoluted because of the timing. It's
yeah,
convoluted of potentially when you actually find out that you haven't met
you haven't. Yeah,
the,
that's
the
right.
payment standard, and then that just sets off a whole lot of other dominoes where you've got to do this and do that. Uh, you just don't want to do it. Like
No,
seriously, it's just the pain is just
just avoid it. You
unbearable.
need to
I
avoid
think,
it.
yeah, and
Yeah,
completely disproportionate to potentially a lazy error or
yeah.
something,
Inadvertent,
yeah,
especially when someone
overlooked.
dies, right? So you've got, the person's died. The last thing they might be thinking of is making sure they get their pension exemption. And particularly if they die in that, like in June. So they're dealing with the grief and probably trying to figure out like who's Arthur or who's Martha sort of thing. And then if they miss like one payment they miss and it's an issue. Now there is a discretion there that can be applied, but you only get to use it once. So you again want to avoid, you'd be wanting to use it in a really inadvertent situation rather when there's something that is avoidable. So and particularly if it's a year that there's a substantial realised capital gain. So that pension exemption it really has a big impact on the tax position for the fund. So yeah, really, really important.
Yeah, just don't get that. I mean, I know it's easy to say, but the mantra should be just don't get it wrong. I mean,
Hmm.
that's what the bottom line is because it's very unforgiving.
Yep.
Um, and as
And
you
if in
said,
doubt, just pay a bit more. Like,
yeah, because as you said, Gemma, if you're talking about, reversionary pensions or death benefit pensions or anything like that, imagine what your mindset's going to be as far as trying to sort that out. I mean, I can
non-existent.
imagine that every single death is a fairly emotional period in a person's life.
Yep.
And to try and get your head around other matters while you're dealing with the immediate grief and those first-hand issues, I'm not sure that pension payments are going to be right up there
Top it. Yeah. They're not going to be
with
top. They're
with
definitely not going to be
stuff that
top of
you
the
have to do.
priority
No,
list. That's
no,
right.
no.
Yeah, 100%. And even like, this isn't a session about death, but contributions might have been made for someone who then dies quite suddenly. So then you've got how are we treating those contributions, 290, 170 notices, how does that all factor in? So back to my comment earlier of if you're making a contribution and you know that you're intending to claim it as a deduction, do the paperwork there and then. It's a bit like making a downsizer contribution. You need to have the form completed either before or at the time of the contribution. It's none of this post consideration. So yeah, getting like just ticking all the boxes along the way, I think is really important.
It's just one additional step, really,
Mm.
to complete the process. I mean, again, I know, I know in people's busy lives it doesn't always happen like this, but just go the extra yard. You
And
just
if
got to go
you're
the
the
extra yard.
advisor or the advisor or the tax agent and you're involved in that contribution process, then again, it's just another piece of paperwork that has to be done anyway. Just do it up front when it's fresh in your mind, you know, in real time, effectively, rather than waiting for a year later or whenever the accounts are being done or the person's individual tax return, etc. So anyway, that's a really, really important one.
Absolutely.
Those
Look, and
two, the big ticket items, those two, the pensions and the contributions.
absolutely. Look, in sporting circles, they always talk about going the extra yard and potentially that paying off, particularly if your opponent doesn't go the extra yard. Well, in this
Mm,
context, just go the extra yard and imagine all of the compliance pain you'll save yourself if you
yep,
just go that slightly, longer with the process and just get it all done. Mm,
yep,
mm, mm. You know,
100%.
you can't argue against it, I don't
No,
think.
no,
You know, needs to
yeah,
be continually emphasized.
yeah. Okay, so other bits and pieces is, and particularly when we're talking the liaison with related parties. So, if you've got a related party limited recourse borrowing arrangement, just making sure that all of the repayments as required per the PCG and the loan agreement have occurred. So the principal and interest and all that sort of stuff. Because again, what can happen is when the interest rate changes every year, people have set up a direct debit based on the previous one, and then no one's potentially looking at it. So then for this year, it could be that all these payments have been made, but they're in accordance with last year's rate. Now, in this year, it went down. So if it was a previous direct debit, then you're probably all right. But just to watch out for that, and especially when in May that rate will effectively be released for the following year. So it's then setting up for success. I think is what this whole episode is about. So there's that one, the rental payments, and where the fund leases a business property to a related party. So just making sure all those payments are made, any outgoings are covered off. We can encounter some considerations with GST from that perspective. So it's just like doing a bit of a reconciliation. Has everything been made? And the consideration with all of this is if you haven't been making the right rental payments over the course of the year or the borrowing interest and principal amounts, in practice, if everything is tickety boo by the end of the year, then any compliance action tends to be sort of kicked into touch or
Mm.
goes through to the keeper. What other sporting analogies can I do? So,
Yeah.
so again, that year-end thing, if you can get everything sorted out. So even if there is a breach, when the auditor's signing the audit report, they can either say, okay, well, I've qualified the audit report, but the issue has been resolved, or I've had to lodge an ACR, but the issue has been resolved. So that issue being resolved makes a big difference. And if it can be resolved by 30 June of the relevant year, then that is a tick in the right direction. And the same goes with the reimbursement of expenses. So when you've got the situation that the member pays for the accounting fee and then gets reimbursed, or anything that might be like that, then again, to prevent that from being classified as a contribution, then the best, which could have an impact on other strategies, the best thing is to obviously to have that reimbursed back. And this happens more than people probably appreciate. The invoice gets sent out. Someone's looking at it going, oh, it's got my name on it, even though it might say, Jemma Sanderson and then the Jemma Super Fund, but they just see the Jemma bit and they pay it from their personal bank account. So, there's some misunderstanding about who has to pay those. Oh, I can't pay that from my super fund. It's like, well, yes, you need to because it's in the name of the fund. So if you're going to reimburse those expenses, making sure that that all happens pre 30 June as well. And then again, all of those things, like we see it loans in and out of a fund. That's where there's cash and it gets moved around. You could have the situation that the fund trustee is the same as the family trustee, and money comes in and out. I mean, that's not ideal, and most people advise against it or recommend a change to a different corporate trustee. So, there's ways to remedy it. But if those are identified, look, let's just get them sorted out before 30 June. Again, there could be a breach, but if it's remedied, then when the auditor lodges their ACR or they qualify the audit report, that's ticked off on as well to say, yes, it has been resolved.
Yeah, these are all pretty good, just housekeeping issues, really,
Yep,
aren't they, Gemma?
yep,
But it's it's very easy because there's no definitive line. Yes, there is mentally in the calendar. You
yep.
know, June is no different to July in the normal process of things. So if you're talking about lease payments or whatever, there's no reason why you wouldn't specifically just say, oh yeah, it just rolls on and on and on. But
Mm.
if there's a change in interest rates or something like that, yeah, you have to be conscious about that. I know that, you know, the sun coming up the next day makes absolutely no difference to whether or not it's the 30th of June or the 1st of
1st of
July. But
July, yeah.
these are the lines that you have to be conscious of
Yep.
to ensure that you do the right thing because again, the compliance pain that
It's not worth it.
will be brought
It's not
upon
worth
you
it.
is
Yeah,
especially with LRBAs and that sort of thing, that is
yep,
completely disproportionate to what might be a slight error,
yep.
inadvertent error, fundamental error.
And the
Um,
other thing with the rent payments is we see lease agreements that have expired, but they've just kept them going. They
yeah,
index, the payments get indexed at CPI. So it's all ticking along. But then it's the lease agreement expired some time ago. Now, that ticking along might be okay because the lease agreement allows for it. But it's like, let's check the lease agreement. It's been indexed at CPI. Is that correct? Should it have been at market every year? Again, it's just housekeeping things just to tick off on all of those bits and pieces going forward, and that probably brings to light like another consideration in the lead up to 30 June, where we can do a plug for SMSF property valuations is getting valuations done. So we've
yes,
got for
yes.
year end purposes, 30 June 2026, a property valuation or evaluation of many assets will need to occur. And because we are going to have Div 296, an effective date of 1 July 26, and I'm expecting quite a lot of SMSFs will elect for the cost base adjustment. Robust valuations of assets at 30 June 26 is not just something for 30 June 26 accounts, but it will be for then that tax purpose of having an adjusted cost base for those relevant for all of those, well, all of the assets in the fund if you're making that election.
Yeah, totally. I mean, I know that I always talk up the valuation processes,
Mm,
especially seeing that they're sponsors of our podcast. But this is rapidly coming to a head now.
mm,
We've always talked
100%.
about Division 296 in a future sense, but the implementation date has actually been completely fixed now.
Yeah,
So now's the time to get your skates on, especially in light of the CGT adjustment that you're going to have to declare. And not only that, I mean, this is another layer on top of the cake if you want to put it like that. But auditors themselves have come under increased scrutiny
yep,
around valuations in prior years and certainly in the last 12 months in the lead up to this. But even before we're talking about Div
yeah,
296, there has been increased pressure on auditors to make sure that the valuations they see and they need to tick off are actually done correctly. And there's a lot of errors that happen out there too, as far as what you
mm,
can use as a valid valuations, what you can't use. I suppose the one issue that continually needs to be pointed out, Gemma, is that you can't, and I don't know whether or not you see a lot of this, but you can't rely on, oh, but Gemma, I only have to do one every 3 years.
every three
No,
years.
That's
Yeah,
that's what the rule is, isn't it? No, no, I'm all right. I'm within the 3 year window.
Yeah.
That's a myth.
It is, well, that's a myth that I think was, I don't want to say perpetuated, but was acceptable in the industry. But that's not really been the case for 5+ years because of that extra pressure on the auditors. And what's going to be different about 30 June 26 is that this isn't just a valuation for the purposes of the financial statements. This is a valuation that will, if you're electing for a cost base adjustment, it's a valuation for tax purposes. So it needs to have some more oomph behind it or more robustness than, oh, well, I used last year's or one from 3 years ago and I still think it's okay. So it's, yeah, you're going to have that situation where if you get called to task in a few years' time and, oh, no, I just used an appraisal from a few years ago and that's what my cost base adjustment is based on. It's like, well, that's probably not going to pass muster where you're looking to argue that your Div 296 valuation is, well, your adjustment is what it is. So the importance of valuations this year, and we're talking here about property, but it's also looking at private, and this is notoriously a challenging one, is the valuation of private company shares or private entities. So a unit trust or a company that is backed by property, again, you've got like that consideration that someone can go in there, value that property, and then that can flow through to, again, the underlying value of the units or the company. But whether it's an active business, that's where the challenge arises and has arisen substantially in a lot of audit qualifications because that isn't like we can't justify or ascertain whether that is a good market value. So in with the 30 June 26, that's probably going to be of more importance if you're looking at a cost base adjustment. Again, some of the valuation methodology is to value at net tangible assets, but that could be almost zero within the balance sheet of an entity. And some people will be saying, well, hang on, they're not, my shares that I bought in that private company aren't worth zero. They're worth $4 a share. And so, okay, well, unless you can give me something concrete that tells me that, that's going to be a real challenge to value them from that perspective. So then, that dovetails a bit more into Div 296, which is with the cost base adjustment, it's all or nothing in an SMSF. So if you're sitting on funds that have got quite reasonable quite reasonable unrealized gains, then that cost base adjustment makes sense. If you've got assets in there that are sitting on unrealized losses, then the consideration with that is, right, well, if we're making this adjustment, we don't get to cherry pick which assets we're adjusting. It's all or nothing. So are there assets in the fund that shouldn't be there? Are there assets in the fund that we think they're worth $4 a share and the cost of them was 50 cents? How do we value those so that we can show that that is the cost base adjustment? Are there some assets in funds that should be removed from that environment in light of these new provisions? Are there some rats and mice, as people call them, that people should be getting rid of? But for some, they're like, well, they're down now, but they've got potential. So how do we, get that cost base adjustment to be in our favour? Because if it's based on a 30 June 26 value, which is down from the tax cost base, then you're going to have the situation that, say, it does bounce back and recover, and that's when you sell them. For Div 296, you might have a higher gain than for tax purposes. So how do we deal with that? So it's a real, there's some work that might need to be done there for people in that sort of situation. Now, chatting to some people, they're like, oh, we'll just move, we'll get rid of the assets that are in losses. Now, if that means selling them on the market, then, that's an investment decision that also needs to be considered. If it's moving the asset to another entity within the family group, whether that's as a lump sum payment or for consideration, then my question is always, well, which entity is that? And if these do bounce, and what it's showing is it's 50 cents a share, and then it does bounce to this $4. Do you really want that gain in a discretionary trust or in a company or in a person's own name? Is it still better off just staying where it is in super? So that's a big, I don't know. It depends substantially on each asset. And so again, there might be a bit of work that needs to happen there where you've got fund or encounter funds in that situation.
Yeah, totally. And it kind of lends to the emphasis of the point that we made earlier about the timing of what you're doing and the timing of transactions. Because just say it is a property, you can't offload that tomorrow.
No.
I can't take a property and say, oh, Gemma, I've actually decided, in reviewing the portfolio, this is probably an asset that I should get rid of. So that's okay. I mean, to be honest, we're approaching May. That could
Yeah.
already be too late.
Yeah.
I mean, I don't know how long it takes to sell a property, but I know it doesn't take overnight.
Well, especially if it's a commercial property or even residential, again, that can take a long period of time. I think that's where Div 296 has, like, we've got that transitional year. So if you do decide, look, longer term, this property shouldn't be in the super fund or that asset shouldn't be in the super fund, you do have that consideration that you can sell it. If you sell it in that first year, then it's not based, and it happens to come out as a lump sum, then it's only your closing TSB that is taken into consideration. And yes, there might be a taxable income because of the capital gain, but if you run a cost base adjustment, then it's only going to be any increase between the value at 30 June 26 and when you sell it that will be caught. And if you're selling that asset within that year, you're probably and you've got an offer or it settles, then that's probably going to be the value you would use for 30 June 26 anyway. So it's not going to create a massive issue in that year, but it's still something that people might want to put their minds to sooner rather than later.
Yeah, and the fact that, as you said, you can't cherry pick if you're going through this process, right? It's basically an all or nothing
Mm,
proposition here. And that, of course, every SMSF is different. I'm not saying
different. Yeah.
that they're equal in terms of complexity or anything like that. But the concept in itself of having to adjust the whole portfolio, that's that's a big job in itself. That's
Mm,
potentially a big task in itself. So it's not just like, oh yeah, it's all right. I've just got one thing here that needs to be determined. If you've got a couple of properties and a couple of other things, then that in itself can be quite an exercise that again, you've got to allow time for and
that's right.
do properly. Like the last thing you want to do is do a rushed, half-baked effort, only to pay the consequences later on down the
Yeah.
line and lament, oh, Gemma, if
If
only
only.
I'd
I do take some
had
sort
more
of
attention.
comfort's the wrong word in the fact that we've got that transitional year. And I think, because again, when these provisions came out just before Christmas, 1 July start date, passed in March, regulations at the time of the recording of this particular podcast were in draft and all the submissions and responses had been submitted, but we hadn't heard whether there were any changes yet. So what we're working with that only kicks off in a few months' time, it's still unclear on various bits, but that transitional year, I think, by and large, will make a real difference. But I think people can't just put their minds to it on 1 July. They need to put their minds to some of it before then, just to make sure that they're not missing anything. But it's just that's going to create just extra work for everyone when as where everyone's at capacity as it is. So that in itself is a bit of a challenge. But that
Gemma,
transitional year is fantastic from that perspective.
Gemma, why would we ever expect all of the legislation and the regulations to be bedded down by the time this thing is supposed to be implemented? I mean,
Oh
silly
no, it's
us.
outrageous. It's
Why would
outrageous that we
we
would expect
ever
that.
expect
Yeah,
that to happen? I mean,
yeah,
a ridiculous notion,
yeah.
obvious.
Ridiculous. Completely ridiculous.
What are we thinking? What is
Yeah,
anybody thinking to have that sort of expectation? You know,
yeah.
yeah.
So Div 296, yeah, bits and pieces there. I'm just looking at my little list of other bits of other things. Oh, the other one that people need to be aware of is in-house assets. So people might have a closely held trust, as an example, and it's not an in-house asset because it had like the SMSF and its related parties might own 50% and control 50%, and therefore if they've got if they're at that level, but then there's other parties or another party that's 50% control and ownership, then it's not an in-house asset. So that's a big tick, right? But part of that element is not just the ownership interest of the underlying, and I'll call it a unit trust. It's then looking at who are the trustees. So if the trustee, hopefully, is a corporate, then who are the shareholders of that corporate and who are the directors of that corporate? If it's just individual trustees, then again, who are they? So if it's Gemma's super fund owns 50% of the units and Darin's super fund owns 50% of the units, then if just Jemma is the trustee of that unit trust, then that's an in-house asset for me. If there's a trustee company, the Yoda Nominees Proprietary Limited. If that's sitting up there and you and I are both directors and we're both equal shareholders of that, then again, we've got that straight down the line consideration. Now, what if you die? Sorry, I'm killing you off. You
Well,
die
thanks,
or become
Jim.
incapacitated and you have to cease being a director of that unit trust, of that company, rather. And so all of a sudden, I'm the sole director, which means I'm the controller of that company, which filters down. Now, if that gets detected this time of the year, it might be okay. It's an in-house asset now, but the test time is 30 June. So as long as by 30 June, there's someone in there who is not related to me that replaces you, then, that's going to tick the box from that perspective. So it's just watching out for those. And that's a quirky provision just to watch out for. But it's the same with, yeah, you just don't want to, in-house assets can be quite nasty, especially when you've got, okay, well, now I'm over the 5%. And when you're over the 5%, you can't just wait for valuations to resolve themselves. You've got a requirement to put in place a written plan to dispose of the offending asset that's above the 5% by 12 months after the end of that financial year. So again, back to that whole like the compliance side of it and all the extra bits and pieces, and it might be highly inconvenient to do that. And who's going to buy those units off the super fund or those shares? How's that going to be funded? Does it impact the underlying activity within that asset? There's all these other things that come through. So really, really important to be aware of that as well.
Yeah, it's another one of those things where uh, if you're deemed to have in-house assets, it just sets off another chain of events,
Chain, yeah,
the path that you really just don't want to go down. I mean, it's a lot of this is about avoiding the compliance pain that you might face
that's
if
right.
you just overlook some of these things, which are really, in the scheme of things, pretty easy to deal with.
Yeah.
If
And
you
that's the
put
other
your
thing
mind
is
to
some people say, oh, the SMSFs are really limited in what they can invest in. And I just shake my head and go, no, they're not. There's just extra requirements with some of the investments or assets that they hold. So it doesn't mean like there's actually like quite a wide range of assets and structures that an SMSF can hold. But if you're not on top of how those work and how those interact, then that's really, really important. And actually, on that, flowing on from that unit trust consideration is that with any particularly closely held unit trust, there was a ruling or an ATOID, I think it was an SMSF ruling back in the day, 2008 or something equally
yeah.
horrendous, or 2012, anyway, 2010, anyway, whatever it was. So the profit to avoid in-house assets, so it wasn't 2008, I think it was 2010. So this whole what is an in-house asset? What's a loan? What's equity? All of those sorts of things was considered in this particular ruling. And so when it's a closely held unit trust and it generates a profit, then the expectation is that that profit is distributed to the unit holders by the lodgement of the return of that unit trust the year after. So again, you've got to watch out for that. And that was particularly an issue for a lot of pre-99 unit trusts because they might have had a loan in them still, which was perfectly fine. But if they had principal repayments, then that's going to reduce the available cash then to pay out that profit or that profit distribution required by the end of the following year. So again, just watching out for how that all works as well.
Yeah, and that can be difficult, can't it?
Yeah.
Gemma, because if you don't make the distributions in a timely manner, that can actually be perceived as providing financial assistance, can't
Yep.
you? Can't it?
Yep.
And then that, again, I know this is a common theme, that sets off a whole other
Oh,
myriad of stuff that you're going to have to deal with. And of course, that can be totally innocent and inadvertent.
yeah, that's right.
How
Because you've
easy
got
can
a
it
loan
be
that's
just
sitting
to say
there.
that, oh,
Yeah.
yeah, look, I'll get to it when I can. I know I've got to do it. I'll get to it when I can, blah, blah, blah. Only to find out that a small period of, but Darren, you didn't get to it quickly enough. Yeah, yeah, I know. I know I had to do it. I didn't quite do it on a timely manner. Well, you've actually
What's the
now
big deal,
been,
though? What's the big
yeah,
deal? Well, actually,
well, actually, you've been
yeah,
deemed now to provide financial assistance to another entity. It's like, huh? What?
yeah,
How can that? I know that is an extremely harsh interpretation.
yes.
I do admit to that, but it's an interpretation no less that in these sets of circumstances you're going to have to deal with.
Well, and it could be a breach of the sole purpose test because, there's been cases of that where the unit trust that was owned by the super fund didn't pay things like up to the super fund over time in Montgomery Wools, and that was a breach of the sole purpose test. Then you've got, well, that would be an in-house asset. How do we manage that? Is that just, oh, whoops, let's just get it paid up? Do we need to accrue interest on that? How are we treating it? Is it over 5%? What is that? How does that impact that underlying trust? Back to that compounding flow on effect. So really, really important. Again, housekeeping, being an awareness of, okay, this is a particular type of asset that is fantastic for a super fund to be invested in, and it's been, of real benefit. But if we're not aware of the little, the check boxes on the side in managing that, then that can just give rise to some real issues there.
And I think it might be you, Gemma, that has emphasized this in the past when you've been talking about related party issues and in-house assets. I know that we always look at thresholds as being, as long as you don't go over it, you're okay. But and this isn't a year-end issue. This is more a matter of good housekeeping. Would suggest that don't go right up to the 5%.
No, no.
There's always this perception, you know what I'm talking about, where
Yep.
I know that the envelope is 5%, so I can push the boundary right up to that 5% and I'll be okay. But you're not actually adding any sort of buffer that if something
No.
goes against you, it's immediately triggered, and then it's like, oh no, now I've got to do all this other stuff
Now I've got
because
to
I've got
do
too
loads of other
bloody
stuff.
close.
Yep.
Oh, it's all right, Gemma. It was 4.95%. I'm still okay. Well, that amount of margin is not going to it's not going to save you from any sort of inadvertent event that
Mm.
might, oh, now you're over. You know that, don't you?
And I think some people are still banking on during COVID, there was a concession where a lot of valuations went down. And so people were ended up inadvertently over the 5%, even though historically they hadn't been, just because of the way things were. And they allowed people like that 12 months to recover. So if the other assets went up and you fell back below the 5%, then that was okay. But that was just it was a transitional little one-off concession and not something that that carries on. So, people really need to be careful that that they're ticking the boxes and watching out for that. And that can be a challenge, especially when you pick up a fund that might be multiple years out of date. And so all of a sudden you're identifying some of these issues. So, I mean, that's a whole thing in itself, just looking at, how do you resolve some of these issues? Well, it depends on what the issues are. But, this is one where it would be probably an in-house asset. How do you deal with it? Do you just sell the asset? Et cetera, et cetera. So like plenty of bits and pieces to be thinking about there.
Now I know we're getting to the end of our session,
We are.
so I thought I'd chuck in, well, two things actually, Gemma. Just wanted to pick you up on one thing. You should have, the unit trust shouldn't have been
Yeah.
the Yoda unit trust. It should have been something like
Simpsons.
the Springfield unit trust.
Yeah.
It's just
Yeah.
a small thing, but I got it
I
in.
know.
I got
I
the reference
know.
in there anyway, so that's
Yeah, we
fine.
got the reference in
But
there. And I was
but
thinking
keep
that
that.
I was like, oh, could have been called the Is it Snowflake? Snowflake 1 through 12 or something was the dog. Anyway,
Oh, Santa's Little Helper, isn't
Santa's Little Helper. That's what it
it?
was. Yeah, yeah, yeah.
Yeah.
That was
So
the
yeah,
one.
well,
That was the one.
we've ticked that box now anyway.
Tick
But
that box now.
yeah,
Yeah, yeah, yeah,
it was
yeah,
a
yeah.
good avenue. But yeah, we got it done. Just the last thing, I know that there's been a lot of noise about this, obviously, in the lead up to 30 June as well for payday super. A lot of it has to do with more the employer side rather than the SMSF side. But there are still some housekeeping issues that SMSF trustees and any practitioner helping them needs to bed down. I mean,
Yeah.
some of it's just little things, but important things like the electronic service.
Service address. Yeah.
You got to get that right because if you don't, then you're not going to be able to accept contributions. Um,
Well, and with some ESAs, so there a few have pulled themselves off the market,
correct.
and so I mean the big software providers they tend to like have them, and so that helps out a lot. But for many tax agents, if they're not using the software systems, and I'll call them the fancier SMSF software systems, then when Australia Post pulls out of providing that, and there's a couple of others, then what does that look like from that perspective? The other one is this new payments platform or the MPP. And
Yes.
so, in terms of for an SMSF to look into that, it would be just double checking. Like we've been talking about the banks and how stuff takes forever. And so, you'd want to make sure that where you've got funds where your clients are getting employer contributions, which I would expect to be quite a lot, that they can receive those amounts electronically instantaneously. So I know OSCO is one of those payment,
Yes. Yeah.
those immediate payment ones. I think there's a couple of other ones. So it's just, double checking that the super fund's bank account that is receiving those contributions ticks the boxes there, because the penalties for that payday super not going through, it's not a penalty for the fund, it's a penalty for the employer, and they're oppressive. Now, the first year will be a concessional year, and this is another thing for people to be aware of, is because like quarterly payments are the current requirement, right? And so some businesses, especially if they're a small business or it's a not for profit, they will make those payments quarterly because they're not necessarily or hadn't been geared up to make them more regularly. Most businesses pay, well, often will pay their super contributions at the same time they pay their salaries. But again, there's been this they've might not necessarily have been the urgency on that because it goes through a clearinghouse, etc. But with the small business clearinghouse shutting up shop from 1 July, that's also a consideration there. So yes, the SMSF needs to be, I'll call it payday super enabled, which shouldn't be that much of a challenge with an ESA and making sure that they've got a bank account that can receive immediate payments. It's definitely a consideration for a lot of small businesses and your business clients that are out there to cover off on it, because I know that even the software packages and the salary packaging people are concerned about whether it's going to be able to be implemented in time and within the 7-day period.
Yeah. I mean, great decision to shut down that that
Clearinghouse, yeah.
clearinghouse because I use that clearinghouse, and so
Yeah,
I'm in the, you know, in the boat of needing to rearrange my affairs because
yep,
I use it. So, and the ATO has actually ATO I think it is. They've actually just put out a release to say that they've cleaned up their list
yep.
so that their list is up to date as to which providers are going to be all right and which aren't.
Right. Okay. I haven't seen that.
Yeah, I would suggest referencing that would be a good starting point because again,
Yeah,
you
definitely.
don't want to fall foul of this. The other thing that maybe just trustees might need to be aware of in this whole scheme of things is actually how it's going to impact employers as to what their processes are. I know this is only a small thing, but it can just be the anticipation of when contributions are going to come in. At the
Yeah.
SMS Association conference, Gemma, I had conversations with smaller organizations to say that they're actually changing because of cash flow considerations. They're changing their pay cycle from weekly to monthly.
Ooh, and that's full on just for
Yeah, that's massive.
employees,
I,
even going from a weekly to monthly.
I know.
So yeah, yeah, that's well, the other thing with it all is if people have been receiving their contributions quarterly, then usually in July they would get a substantial contribution for the June quarter. So and then so let's say that happens because you'll still have that by the 28th of July 2026, the contributions for the June quarter can still go in and you've ticked the SG box. So then the other consideration there is, well, if you're then getting monthly, if your pay cycle is monthly, you're then getting monthly contributions after each pay or within 7 days of each pay. Are you going to go over your cap next year?
Yeah.
Now,
Yeah.
the tax office is aware of this, and I believe there's been a lot of advocacy to Treasury to put in place a legislative amendment because you can request for the Commissioner to exercise his discretion to reallocate a contribution to another year. But feeling is that like next year might be an issue where people go over their caps, and even in the current year because you might have at for the July 25 quarter a big chunk went in for the June quarter, and then employers have gradually been getting back onto the into the monthly cycles. So it could happen this year or next year. Now, the intel I have is that the expectation is there will be a legislative fix for next year, but not necessarily for this year. So just for people to be aware of, there could be an excess contribution that comes through this year if you've got clients that are in that realm.
Okay, Gemma. Well, I think the year-end soup, as you described it,
Soup,
when we're
yeah,
discussing this session off air, uh,
yeah,
I think it's been brewed because we've
yeah.
run out of time,
It's ready.
as,
It's
as
ready.
usual. It's
Yeah.
ready for drinking. So a lot to
Yeah.
process there, but hopefully you steer clear of any compliance issues in the lead up to year end and maximize those strategic opportunities. So the only thing left to do is thank you again, Gemma, for the sharing of your brain power during this session, as usual. It's been
Thanks for
very,
having me,
very
Darin, as
informative.
always.
It's been really informative. Thanks to SMSF Property Valuations. Again, we spoke about valuations a lot, and they are going to come to the fore a lot,
A
particularly
lot.
in the
Yeah.
coming months. Thank you again to my production team who puts this all together and makes sure that it gets posted and published on all of our appropriate social media platforms, as well as any other mediums that we choose fit to publish these episodes on. Most importantly, thank you to you for joining us. I know I always say this, Gemma and I do have a lot of fun putting these
We do.
sessions together. So I hope you enjoy it as much as we do enjoy bringing it to you. But more importantly, I hope you got something out of it so you can actually say that, oh, I actually learned something there. So until the next time we put together a cross-country super podcast, it's goodbye and we'll see you soon.
Bye, everyone.